Time for our special quarter segment where we are kicking it off with IT in focus. Reema is here to set the stage for Q2 expectations across large cap, mid cap companies. Reema, take it away.
Thanks so much for that. So this quarter for the Indian IT companies is expected to be stable. But so far, there are no signs of a demand recovery. The good news is that unlike in the past few quarters, there is no further deterioration in demand. So here's what the CNBC TV18 poll looks like. So constant currency revenue growth for TCS could be muted, just about 0.2, 0.3%. Off the lot, Infosys is likely to lead with about a 1.8% gain. HCL Tech stands at 1.5%. What will work as a tailwind for Indian IT companies is the INR depreciation. The rupee has fallen nearly 2.5% against the dollar, and that will act as a tailwind for margins and protect the margins against any AI-related deflation or pricing pressure. So margins will look better. For Infosys, margins are likely to go up by 50 basis points. For TCS, close to about 20 basis points. Company specifics will matter. For TCS, for instance, continue to watch for the tapering of the BSNL deal, and even if this whole JLR rover cyber incident has had any impact. For Infosys, as always, the FY26 guidance will be at the center of all investors' attention. The current guidance stands at 1 to 3%. The guidance could be tweaked. Maybe it stands at 2 to 3%. But the guidance for Infosys will be material only if the upper end is raised. That's the 3% mark. For Wipro, as always, it's a test of the company's turnaround story. For Q3, the street is penciling in a guidance of 0.5 to 1.5%. HCL Tech, FY26 guidance likely to remain unchanged at about 3 to 5%. For Tech Mahindra, watch for the margin reset story and the commentary on the telecom vertical. But across the sector, what investors will watch for, whether the AI-led renewal deals are getting traction, if AI is getting monetized beyond pilot projects. And the other, watch point, and which has captured, so much of the investor attention, is the impact of the H-1B visa costs. Is that going to hurt on-site delivery, the cost structure? What about fresher onboarding, headcount, overall attrition? All these will be important signs of demand visibility going ahead. And of course, markets will wait to see what TCS and Wipro have to say about a potential buyback after Infosys recently announced one. The big question all investors are grappling with when it comes to IT is that it's an unloved sector. It's not done anything. It's a serious underperformer from the start of the year, down about 25%. So does it turn into a value buy? Just to put the valuations in context. Now, historically, large cap IT companies used to trade in a band of 15 to 20 times forward multiple. TCS right on top. Then you had the pandemic boom and the valuations dramatically increased to about 25, 30 times. And for mid caps, it went as high as 60 times. But again, over the last 2 years, as demand has slowed down, valuations have actually come down and come back to long-term averages. So today, an Infosys, TCS, HCL Tech are once again back in the 17, 18, 19 times range, valuation multiple, which is fine until you look at the growth expectations. For FY26, this is the Jefferies have pulled that up. Look at the numbers, right? No growth for TCS, just about a muted, 3-4% growth for Infosys, HCL Tech at 6%. So we're talking about low to mid-single digit kind of a revenue growth. And that is the big question. Is it a contrarian value buy today, or is it still too early to buy? Back to you.
Okay, all right, Reema, got it indeed. And that's the interesting question as we get into this season, that you have to look beyond the near-term weakness and look at a tactical buy or not. Manik Taneja, Executive Director, IT Services and Internet at Axis Capital is with us. Manik, great to have you join in. So let's talk about the bare basic numbers like Reema's put on the table, that, expect between 0.5% to, in best case, maybe up to 2% growth, if at all, this season for the large cap IT services companies. Now, going beyond looking at the second half, do you expect any acceleration or pickup in spending? Or do you think this year will be more or less the same? So let's get the growth question out of the way first. Are you expecting a pickup this year? And then how does FY27 look like?
So first of all, thank you for having me. And with regards to your question as to whether things pick up or not, but in general, over the course of last 2.5, 3 years, every few months, we tend to get excited about CY24 becoming better, CY25 getting better, and CY26 as well. But almost all the time, these hopes have got dashed. And I would say it's a combination of aspects at play. As of now, with whatever Accenture has guided for their fiscal, they are not pointing to a significant acceleration. Street, including us, are building in some normalization in growth, but do we see a flush in terms of spend similar to what we saw post-COVID? I think the answer to that is no. And it is continuous basically reset in terms of growth expectations that are now finally essentially getting acknowledged in the multiples for the sector as a whole. And today, if you look at, as Reema was also pointing out, tier one techs trade at similar to lower multiples compared to last 3 year, 5 year averages. We've seen multiples even come off for the tier two coverage, but they are still trading at on par to slightly higher compared to last 3 or 5 year averages.
Absolutely. You know, Manik, one more point on growth. Now, we saw the reaction when the whole H-1B news was announced. We saw that play out in stock prices, and stocks have corrected as well. So has the market fully priced in the H-1B overhang? Or could it continue? Because we know that it's not a near-term hit, I mean, it's a one-time fee, etc. But the point is that given the chatter around offshoring in the US, could it now start being an overhang on deal closure conversations? Could it then therefore push back, deal timelines and getting any fresh business? So to that extent, when the commentary comes out of the second quarter, are we at risk of hearing another negative?
So certainly, as we've also mentioned, that H-1B is a far more manageable risk for the sector as a whole. But as you have also pointed out, this plays a role in terms of potential deal discussions as to how customers are approaching it, and thereby do they take a more calibrated approach, especially with the way US administration essentially is thinking about outsourcing / offshoring from from American companies, and thereby I would say no American corporate would want to be very vociferous in terms of saying they are signing up a large mega deal with an Indian outsourcer and then be in the eye of storm on Truth Social the very next day. So thereby that does impact the setup for Indian companies. Do these companies have an immediate way out? I would say the answer is no. Some of these global companies work with these vendors, also have their GCCs, and whether it is an Accenture or an IBM or even the JP Morgans of the world, all of them essentially use Indian talent for supporting their technology needs. So I would say people will try to essentially work around with these regulations, but certainly have an impact on the way deal discussions progress.
Yeah, which is why that question of is that another growth risk? But okay, very quickly, we're hitting market opening. In terms of stocks, what to do? Is there anything on your buy list at all? If not large cap, maybe mid cap, where the growth rates are relatively better off.
Sure. So I will first of all say, since you guys have been highlighting that the stocks have come off and it's an unloved sector, just look at global tech services over the course of last 5 years. The likes of Accenture, likes of Cognizant, likes of EPAM, Globants, the world would have delivered very modest returns to probably even negative returns. So the despondency in Indian IT is only catching up. The second thing that I would say from a sector standpoint, from a rating standpoint, Infosys and Wipro essentially remain our preferred picks amongst large caps, Mphasis amongst the tier 2 techs, and we have a buy on both First Source and Sagility in the tier 3 universe. So we'll continue to stay very selective in terms of our ratings.
Yeah. All right. Thanks very much, Manik. Appreciate you joining us.